to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you, intro man. Coming in at a very different time of the week, but as consistent as ever. Mixing it up a bit this week, I'm joined by Mike Sharp once again. We're going to be talking about contrarian investing and that general philosophy and the benefits and drawbacks of contrarian investing, as well as what it actually means. What does it really mean to be contrarian? And it's sort of as a teaser for some upcoming content here on the channel. Mike will actually be doing a show for Punch Card Investing, a separate show from our kind of main show we're doing here. And it'll be talking quite a bit about these sort of contrarian topics, or using it as sort of a theme. So with that as a kind of a teaser, this should serve as a nice little intro into that into that world of value investing and stock investing more generally. But before we get into that, definitely be sure to subscribe if you're here on YouTube, or if you're listening to this via podcast, definitely subscribe on whatever platform you're on so you don't miss future episodes. This is, like I said, if you're watching this live, it's a very different time than we're normally doing in the middle of the week. But thanks to a bunch of traveling going on in the next week or so, it made a lot more sense just to get an episode out now while we could. So with that as sort of our background, like, comment, subscribe, all that great stuff. Check out the stuff in the description below. And welcome again, Mike. I'm not sure if this is an awkward time for you or not, but I know it took us a second to get on because it's certainly out of my routine doing it right now.
Yeah, thanks for having me, Jack. I always enjoy being on. Glad to do it. Yeah, and I think that, this is as good a time as any for me, like during the day. So let's do it.
Yeah, well, we might have a new live audience here. If you're new to the live show, then definitely feel free to leave some questions or comments in the chat, and we can try to get to them as we kind of go through our topic here. But we were kind of talking between you and I about when we were talking about show ideas, for example, since you were interested in doing a show for Punch Card, and we were kind of trying to figure out where to go with that. And you were very quick on the sort of contrarian train, like just talking about contrarian picks and contrarian investing more broadly. What is contrarian investing exactly? I think everyone has an idea of what that means, but it's probably different for every person, at least a little bit.
Yeah, I don't know if there must be a technical definition of it somewhere, but I think that, it's based on the basis of it is going against the crowd, right? Like going against the predominant sentiment, and basically going in the opposite direction of what the standard thinking is, right? So like within that, you have stuff like, unloved stocks, right? Stuff that's just ignored by the general market, stuff that can be really boring and just ignored. You can have stuff that's actively like hated, like I'll probably use Meta as a lot of in a lot of this today, but 6 months
on both
ago,
sides,
Meta was just hated by everyone, right? You could it was, and Zuckerberg, as a human has been hated for years, right?
You say as a human, that's interesting, but
or as a robot, whatever. I think that personally, what a lot of the time what I see, what I look for is that kind of like a temporary problem that the market is pricing as a permanent problem, right? Because we know the market's pretty short-sighted. So sometimes you get these problems that might get resolved in a year, but the market is going, okay, I'm out of here. This is terrible. What a disaster. And if your time frame is just a little bit longer than what the market's is, you can find stuff that can revalue over, year, 2, 3 years.
How do you determine what the market is thinking or feeling? Because, to be contrarian, you kind of have to know what the general stance is. It's just based on what price movements, news. What are you looking for?
Well, the first thing that I always see when it pops up is the ski jump chart.
Sure.
Right. Like that's a pretty good first indicator. But I think there's other ways that are less, I guess, precise. Like if seeking alpha,
Yeah.
right? You can.
Yeah, we have an affiliate link in the description below, Mike.
Oh, okay, there you go.
For Seeking Alpha.
I didn't know that.
So check that out if you haven't already.
It's a great way to get, because people are just putting up their thoughts, right? It's a great way to sort of get a feel, like take the temperature of the market. And also basically, if you read the mainstream financial news, CNN, and what is it, MSNBC?
Yeah, CNBC is the
NBC. Yeah, like even the Wall Street Journal is maybe a bit better, but like that kind of stuff, that they're really speaking to the general audience. And I think my number one sentiment temperature check is Jim Cramer, right? So, I mean, there's the inverse Cramer Twitter account and fun.
Of course, right? Yeah, that's always a classic. Okay, so yeah, I kind of concur there. It's just general media, CNBC being a big one for me as well. Seeking Alpha is very good as well for more call it individual investor takes, if you will. Maybe some smaller investors or analysts who are following the stock but aren't maybe at the big national level, like someone on CNBC or something, or someone who would get invited on to CNBC. So I think that's a pretty good way to gauge it. Maybe Twitter as well could be a good one too.
Twitter is great. It's true.
Yeah, more generally for aggregating a lot of these sources.
Totally.
Okay, so let's say you identify something that is getting beaten down. What's do you have like a process you follow to be like, okay, are people wrong here? Do you ask a certain set of questions? What are you actually looking for?
I don't know if there's much of a set process, but I think that so if I back up a bit, like one of the things I also do is like I look at my own thinking, right? Because linear thinking is, I think it's what creates sentiment, right? So if you take let's say you get a set of news from whatever stock, and your first set of thoughts that you have and processing it and say, okay, what does that mean for the stock? That probably means it's going to do this, right? It'll go up because of, I don't know, Alibaba started to, talk about AI, right? The stock's going to go up, right? Sure. But the thing that I realized, I don't really want to speak for anyone else, but I think what happens in the market is everybody thinks they're not part of the herd. Right?
Yep.
So once I realized that I was part of the herd, what I had to do was take my initial set of thinking and then go, that's probably what everybody thinks. So I should look at the opposite of that. I should challenge my own thinking. Maybe I'm consensus sentiment, right? And once I learned to do that, it was, it opened up a few sort of different ways of looking at things. Sorry, I didn't answer your question. I went off on another tangent. But
actually, before you get back to that, I like the point about I like to think of it more as the average person believes that they're above average. So, what the chances of you being above average are very slim by definition, or at least they're slimmer than the chances that you're average.
49% chance. Right?
Yeah. And you're never going to get a truly honest take because you're so biased. So it's just you can find ways to check that. It's a good place to start. Just identifying it in the first place. Identifying that potential limitation is already hard enough to do. But after you do, what are you kind of looking at from there?
Sorry, I'm going to keep on that point for one more second. So once you start realizing that most market participants are actually smart, there's all these Harvard grads and MIT grads and everything, they're all in the market, right, with way better tools than I have, right? So I'm maybe I might be in the lower part of this thing, right? So so then beyond that, what do I do? Let's say I identify something okay, that, let's say, can I use Meta as an example? So last October, November, it was decimated, right? They released Q3. Everybody was angry about the metaverse spend. The growth had basically stalled. It looked like, they had 0% year-over-year growth, and Zuckerberg was hated. So then what do I do, right? Like I have to figure out I have to do my best to figure out if the problem is permanent, right? And so, that's more art than science, right? But I think you just end up reading and finding what's the actual bear case here that people are jumping on, right? And is that a temporary thing, right? Like metaverse spend, I thought, well, that's temporary. It's either going to work,
right,
or it's not going to work, and they'll get rid of it in a while, right?
Yeah, right. That it was what's weird. What's actually really weird about Meta in particular is, the media and just the general market was just beating it down, partly because the call it a PR nightmare that Zuckerberg was leading with the metaverse stuff, because it just made it sound so unattractive, and it was very expensive at the time. But yeah, it's like they've made a bunch of money before. They're not stupid, like, or at least that stupid that if it really was a disaster, they'd eventually stop. But then it's weird because they didn't really stop the metaverse spending.
No,
they started doing layoffs, of course, but then all of a sudden the media is just back. Just I don't know if it's because AI took over the headlines or something, but all of a sudden it's no longer like the villain anymore. Whereas it was for a good 3-4 months there, it seemed like. But now all of a sudden it's great again. It's soaring higher than ever, which is it was just such a quick turnaround, and begs the question: okay, is the contrarian play now to get back on the other side of that? Is it overhyped now? And then I don't know how you look at that when a stock actually is run up after your initial bet that might have been contrarian at the time, but now it's no longer so contrarian, right? How do you kind of reevaluate that?
Yeah, it's hard. Like being contrarian, I think on the downside is easier than on the upside, right? Because I mean, we saw like what was the highest death toll trade over the last 5 years? It was shorting Tesla, right?
Right.
And it was overvalued the whole time, right? So it's like I don't really short things now because it's too dangerous. Like, but with Meta, for example, like I bought a whole bunch while it was down there, and I've been lightening up as it's going up, right? I still have about a quarter of the position that I started with, but like if I'm buying for a sentiment-based reason like Meta, the reason's gone now, right? It's not like I think it's a great business, but I didn't buy because it's a great business. I bought because the sentiment was terrible.
Right. Yeah, so, that's the thing. Like when the basis is, I don't want to call it momentum, but if that was kind of your initial basis, the market hates it when it shouldn't. But now the market doesn't hate it anymore. It's now why am I here?
Like just hoping for it to go up to 400. Like,
well, so in that case, why trim is why hold any at that point unless you still believe that there's enough meat on the bone, if you will.
Yeah, like I still do the fundamental analysis, right? So I still think it's fairly priced right now for the company that it is. Okay. But I just don't think I have any special insight that other people don't have, right? So I'd rather keep the position pretty small and just kind of like leave it. It's a good question. I don't actually know. Maybe I should get rid of it. I'm still thinking about that. Right?
Yeah, it is. You mentioned that it's easier it's easier when it's beaten down to get in potentially, and then if it does run up, it's a weird problem to have, I guess. It's a pretty good problem, I guess, because it has run up, but something about just like I don't know if it's a desire for more. It's like a greed thing. It's just like it's gone this high. Like, what about a little bit more? And is it that's the kind of limitation, or is it something else?
I actually don't know. Like, so the greed on the upside, you're saying, or the risk on the upside?
Let's say you have a double. We'll just provide easy double on Facebook, right?
Yeah.
So you hit the easy double, and that what's the trigger to actually get out versus, or I guess what is the motivation to hang on? Is it, it's doubled once, why can't it double again?
Yeah, well, I think that if I expand, like contrarian is one part of sentiment investing, right? And then like when you start, there's other parts to it, right? Like when you get momentum, when everybody's jumping in, that's sort of the meat of the move, and you don't really know how long that's going to go, right? So
Right.
so I'm starting to look for things that might be like, okay, this might trigger a change in sentiment. Like there was I forget what the news was today, that Zuckerberg got in trouble for something, but they also said that they were going to start raising their cost levels in 2024, right? So I don't know how closely you follow Meta, but like their cost base is coming down. That's why the margins are expanding. And then next year, it sounds like they're saying that's going to reverse next year. So, markets,
Right.
when stuff gets worse, the sentiment gets worse, right? So it could be somewhere in the future.
Yeah. Yeah. Well, it's just like it's a tough problem because you have the combination of actually paying attention to the fundamentals, but at least with contrarian investing, you're probably also paying attention to market sentiment a good bit, or not so much you're paying attention to it, but the fact that the sentiment got so bad is probably a big reason you got in. And then if the sentiment turns, now you're trying to weigh that potentially, and that's like a challenge in itself. Maybe that's a flawed way to go into it, but it seems kind of unavoidable if it's a truly contrarian position, right?
Yeah, because at some point it's not contrarian, right? And you're like, okay,
right,
now.
right.
I mean, that you sent me some questions, right? And one of them was like, what are the risks and the drawbacks to this, right? And one of the drawbacks I've found is that I own a company called Teva, right? I don't know if you ever heard of Teva.
No, I feel I've heard of it, but I'm not really familiar.
It's a generic pharmaceutical company in
Sure.
Israel. They have a big operation in the US and Europe. And it's a terrible company, and it's crap, and they have tons of debt, and everyone hates it. And like, I bought it at 3 times earnings, and then it keeps going up, and then it'll go up to 5 times earnings. And then you're like, I own this piece of junk. I don't want to. So what the problem that I have is that I think, okay, I'll buy it at 3 times earnings, I'll sell it at 6. But once it starts getting at 4 or 5, I'm like, I don't like this company. Like, I don't want to try and hold it to 6 times earnings, right? So I never quite get as much as I think I'm going to get.
Yeah, I guess that kind of, it makes me think of cigar butt investing, kind of the OG Warren Buffett sort of philosophies, maybe. Because that, by definition, that would be pretty contrarian in that you're buying probably a not very desirable company, kind of like what you described, only maybe quite a bit smaller, and there's not a lot of darling analyst ratings. There's not a bunch of great positive sentiment around it, but there's some value there, just in liquidation value or in something. It's just so cheap that even if it declines for a while, there's enough you can take out of it that it makes sense. If it goes from 1 times earnings to 2, like that's still a double, as long as earnings don't decline too fast. I guess cigar butt style investing, I would kind of wrap into this too. We have a comment here from our man Eunice, who says that contrarian investing isn't part of value investing. I've always thought that value investing is inherently contrarian, at least if you're going off the basis that you're buying something for less than its intrinsic value, which would imply that the market that you're saying that the market is wrong. So I think that's how my definition works. I don't know if you look at this differently. Do you agree with Eunice here?
Isn't part of value investing. I kind of agree with what you're saying, that it's actually the original basis for value investing. Like, I was just rereading Ben Graham, and basically that's what it is, right? You just,
I think you're cutting, Mike, or it might be me.
No, it might be me. How's that?
Yeah, you just got a little choppy there for a second, but you said you were returning to Ben Graham.
So I just read some Ben Graham, and basically that's what he's saying, right? You're finding the intrinsic value, finding something that's trading well below it, which would mean that there's not a lot of love for it,
right?
And then it reverts to that value. And then Buffett came along and said, like, this is the other downside. This is why I think Buffett stopped doing it, was because you can't get the 2, 3, 10 baggers out of it. right? Like those aren't available, right? If you're going to try and find wonderful businesses that have the chance of going up 20-fold, that's not, you're not going to find a lot of them. You can find them, but you're hitting a lot of singles here rather than the home runs.
Most likely. Because at least with cigar butt style investing, you probably don't need a sentiment turn. But if you're trying to get those big, I kind of wonder that. I was just kind of thinking this through. Of all like the 100 baggers out there, how many of them have come after some major downturn or some major like market sentiment trough and had some fundamental success too, growth in earnings and all that, but also a sentiment shift at the same time to where the multiple expands a bunch. Maybe Costco is kind of an example where fundamentals have been great. They've been expanding earnings the whole time, but at the same time, the earnings multiple has gone very high as people see it increasingly as like a defensive sort of stock. So there's kind of a big benefit there on the sentiment side of things, maybe. At least for the big, 20, 30 baggers and those sorts of things. I wonder if there are good counterexamples to that. Just kind of a theory I'm thinking right now.
I would imagine that there are, because, to get 100 bagger, you're going to have to get most things cheap to begin with. And they have to be, they're cheap for a reason, right? Well, what's the reason, right? Like, even if you look back, I don't know if you can pull up a chart of Apple, but I remember digging into Apple, I think it was 2014 or 15, and it was selling at 10 times earnings. And the sentiment was extremely negative because the growth had looked like it had stopped, right?
Yeah.
It's got to be up 10 times since then. I don't actually know.
Yeah, but significantly, we'll say.
Yeah, because the multiple expanded, and then the earnings growth came back, right? It's just like what's the book 100 to 1? No, 100 to 1. Have you read that one?
100 to 1 in the stock market? I actually haven't. No.
It's quite good. He goes through a whole bunch of examples of 100 to 1, and then there's another follow-up one. I forget what it's called, but basically trying to find 100 baggers, and it says you need two things, right? You need the multiple expansion, like you're saying, and you need the consistent compounding growth, right? If you don't have both of those, it's really difficult.
Yeah, that actually makes me think what I think I was talking about this with James on our last show. But when I was reading, or maybe it was on Twitter actually, I recently read The Warren Buffett Way. Finally, I've had it on my shelf for years, but I finally actually got to it. And one thing I just noticed a lot more with that book in particular is a lot of these big winners that he was highlighting were really turnaround plays, or not like extreme turnarounds, but a lot of these businesses that Buffett would buy into would be going through a downtime with earnings. Maybe they had a couple bad years, but otherwise were part of a pretty long-standing brand that maybe has navigated things before, but maybe there's some management change going on. But typically there was something pretty fundamentally bad going on. It's not as though he was just buying like a great company from day one that was, what he now has 10 years later. It was probably going through some rough things and needed a few things to happen to then get back to the wonderful company status, if you will. And that in itself seems pretty contrarian, because he's going in for kind of these turnaround management plays, maybe not extreme turnarounds, but it's not like things were in a fundamentally positive direction when he got into it. It was kind of after he got into it, and he saw that he, through his own business savvy, he saw the turnaround potential, but it's not like it was super obvious to everyone, at least not to the market that was selling it down at the time.
Well, I mean, isn't that the Coke story? The Coke was having a bad time in
right?
The 80s, right? But that's
one of them. Yeah.
And I think it was the same with the Washington Post. I can't remember the Washington Post story, but I think it was similar, that something was really, really wrong.
Yeah. I think basically every example, it talks about the Post and also Coke, as well as a few others. I need to double check on which companies exactly, but they'd have a couple bad years of earnings, but otherwise had good brand value and all the good things that Buffett likes in his wonderful businesses. But really, it would be hard to call them a wonderful business in that year or two that he was buying them. It was more that they would return to wonderful status. I think would be a decent way to look at it, at least for the big success stories. It was rare that they were just sitting pretty and were doing fine, and the market was just selling it off. Usually, there was some reason that the market was selling it off, like earnings going down. Like you're kind of saying before, the market isn't necessarily stupid. Like there are some real concerns that people are thinking of, and you got to ask how valid are those concerns for the long term. They might be very valid in the short term, but if you're a long term investor, that's where you have an advantage, maybe.
And so, well, but sometimes they're like, this is another pitfall would be, yes, I agree. Like if you look at with Buffett's stuff, like almost everything he buys is the chart's doing this, right? I don't know if I can do it like that.
Yeah.
Right. Well, and then Charlie's statement about, or I don't know if it's him or Charlie, but they're basically saying you want to buy a wonderful business at a fair price, right? And I think people misinterpret that as you want to buy a great business at any price.
Sure.
Right. So like, oh, Apple's so great, I'll buy it now. Like I wouldn't buy it now. It's what's it trading at 40 times earnings?
Yeah, right. You need a lot of you need a lot to happen when you're buying it that expensively. Not that it couldn't happen, but the equation is definitely different, I think, is what you're getting at.
Yeah, exactly. It's not just buy great businesses at any price. But yeah, I think the other downside here is that if this has happened to me where you misinterpret, or I misinterpret, this is a temporary problem, and actually the business is in collapse.
Yeah. That's the big risk, I think, with what we're kind of talking about with turnarounds. But I'll call it a light turnaround. It's not like you're taking a business that's, on death's doorstep and then you're turning it around from there. It's more like it's in a bit of a decline. Maybe they're done growing. Maybe they're going to decline a bit more from here. Probably not going to go bankrupt, but they're kind of going through that sort of thing. Is what a lot of those big success stories were.
Yeah.
So you call it a light turnaround, maybe, which is still contrarian because you're betting on the turnaround, which other people aren't, or at least
sometimes just cyclicality too, right? Like I bought a whole bunch of oil stocks in 2020 because the market was pricing it like oil was not the thing that was going to run the world in the future. Like you just have to wait.
Negative oil.
I don't know when it's going to happen, but that's going to turn around. Like oil's not going to be at $25 forever, right? We need it, and stuff like semiconductors. They go through a cycle, right? And so, like that was one of the things I looked at. We're talking about seeking alpha. Like if you look back on the low parts of the cycle with semiconductors, it's like sell, hold, sell, and you're like, okay. and now it's all green, right?
Yeah,
or it was all green last year, let's say.
Sure. Makes you wonder a bit. Yeah, let's kind of get back to sort of drawbacks and risks here. I think you just mentioned a really good one, which is you think that a temporary risk, or you think that something is a temporary problem. It's actually a long-term fundamental problem. Maybe it's an industry-wide problem that you're not really going to avoid. How do you make that determination? Because these things happen maybe over years. What are you paying attention to there? Is there a trigger that would get you to realize that, oh no, this actually isn't temporary, it is long term, I'm out?
Well, I mean, for me, I have to have markers, and I have to have a catalyst usually, right? Mm-hmm. So I can say, did it happen? Did it respond the way I thought it was going to respond? Oh, the catalyst didn't happen, therefore I'm in the ocean with no boat, right? Like I don't know what I'm doing now, right? Like, so I think if we look at, I talked about some of the stuff that I got right, but like I just recently sold ASOS.
Yeah.
And my theory was that they were just going through a cyclical down cycle with their margins, and they would come out of that, and then the stock would revalue. And then what happened is it kept going down. Uh-oh, we're almost bankrupt.
Yeah, right.
Like, and so, I mean, at some point I was going, oh, I'm wrong here, right? Because if there's an earnings recession on the horizon somewhere, and I'm waiting for earnings to turn around, like I have to go through a minefield to get there first.
Yeah, right.
I thought it was going to happen before that, and there's no sign of it. So I said, I took a pretty big hit on that one, and I was totally wrong on it, and that stuff hurts, right? And so, like I think I lost 45%. So that means I've got to double something else just to make it up, right? So there's definite problems with it if you get the analysis wrong.
Yeah. That might not even be unique to, I think, what we're kind of getting to, which is like really contrarian investing. That's just like an investing problem generally. You could always be wrong. Um, and it's determining when you're wrong or deciding when you're wrong, I guess. You never really know until everything's over. But at least you have to you're making these calls all the time, whether you're right or wrong.
Well, like if we go back to what you're saying about cigar butts, and then like Ben Graham, the problem he came up against, my understanding of it, is that he would just buy the stuff that was undervalued and would just sit there forever because there was no reason it should go up, right? He was just waiting, right? So I'm usually looking for something I can say, this should happen at that point. Like I'm looking for a catalyst, right?
Okay.
Like,
and then if it doesn't at that point, then you make your follow-up decision then.
Yeah, like if we go back to Meta, my belief was that the catalyst was that they were going to cut costs, right? And that the earnings would expand and the market would like that, right? If it was all built on a theory that Mark Zuckerberg likes money, right? So he's not just going to sit there and
right, yeah, and burn 15 billion a year or whatever, and call it a day.
Yeah, I'm like, no, this guy wants to make money, right? Like, let's see if he can get back there, because it sounded like he cared after the third quarter. He said, we're going to start managing our costs. I'm like,
right,
hey, there it is, right? Okay, if he does it, great. If he doesn't, if he fails at that, and we're still at flat revenue and flat earnings, then I got to get out.
Yeah, that makes sense. Do you write those down? Like, do you have it written? Because I think that would be very hard to actually do in practice. In theory, it sounds wonderful, but like, it gets emotional if the stock's ripping up or down. Do you write it down somewhere? Like, if Zuckerberg does XYZ, then I will XYZ, or
I usually I take notes, yeah, but I think that was actually my reason to do YouTube, right? Because I had some accountability. Right? Like I didn't even really care if anybody watched. It was like, I'm going to tell my theory to the camera and put it there, and I have to eat it if I'm wrong, right? Because if it's just in my head, I can kind of trick myself, right?
Right. So
like I've actually found a lot of benefit from putting it online, right? Like my Teva thesis got busted, Seritage thesis got busted, Azos got busted, right? And it's there, and it helped me get out, I think, faster than I would have if I hadn't done the videos.
It's on the YouTube thing, or just broadcasting or publishing stuff in general. It's a double-edged sword, because on the one hand, it's like an accountability thing. On the other hand, it almost like magnifies the public pressure. If you're making a contrarian bet in general, because people might think you're doing it incorrectly. Either way, whether it be buying or selling, and maybe that's an unreasonable thing to worry about. Probably is, but it's kind of hard to avoid anyways, just because we're social creatures. But it kind of, I think it magnifies it on both ends. It holds you accountable, but at the same time, it might make you a bit more emotional on the buys and sells, because you have to then go. You don't have to do anything, but you probably feel obliged to go and tell people about it on whoever your following is. I don't know. Do you kind of feel that same thing?
Well, I guess the reason why, we talked about what do you want to do on the channel? I was like, I talk about contrarian stuff. And that's built on my personality, right? Like I really believe that people need an investment style that matches their personality, right? Like I have been arguing with everybody my whole life. Like if somebody says black, I'll tell you it's white. If everyone's going that way, I'll go that way, just because I'll find a good reason. You know what I mean? It's just like,
sure.
It fits. And I don't actually mind if people disagree with me. I don't naturally need confirmation, but I like a little bit, right? But I don't actually.
Yeah, right.
I don't mind if everyone's yelling at me.
Well, at least not as much as the average person, perhaps. Back to that, if you think you're not average, right? That's fair.
So it's a hard style to do if you like confirmation, right? Like it's really hard because you have to go against everybody almost on a lot of these.
What about with information? Because the thing is, like, if you're making a contrarian bet, chances are there's probably a lot of publications, a lot of reports, a lot of whatever on one side, but not necessarily the other. So you're maybe you probably have more of a informational hurdle to reach, or some sort of hurdle to reach, because there isn't just as many resources on the side that you're wanting to take as someone else, like like reports and analysis and that sort of stuff, and maybe even company reports that you might want to see. Is that a problem you've run into at this point, or not really?
I don't know if it's like an obvious problem that I've noticed, but there would be less information. But there are other contrarian people out there, right? So sometimes you'll find a
Yeah,
subject that has a really good point about it, right?
the internet's a big place.
Yeah, so it's a big place, right? Yeah, I don't. Oh, actually, I would say this about like if you, I don't know, do you ever invest in commodities or like?
No, I did a little gold back in a couple of years ago, but it was never a huge thing. But yeah, but go on.
But like if you go into the commodities like gold, or you go to oil or copper is a good one too. Like
Yeah,
there's only bulls because the bears don't write their stuff down. They just ignore it, right? Like if I'm a copper bear, like I'm just going to look at
that's a good
something
point.
else. So it's all confirmation bias everywhere in commodities, I find, right? Like gold bugs are crazy, right? I
Yeah,
love gold myself. I've lost more money on silver than anything else. I love, but find a gold bear argument.
yeah,
There's
right.
there isn't one.
Yeah, that's a good point. Yeah, you're yeah. I wonder why that is. But that is maybe it's because a lot of these gold bugs are often selling gold, or have some link to it. At least with commodities, or usually some sort of um, maybe it's a liquidity thing. I don't even know. Yeah, I wonder why that is, but that's a good point. Um,
Yeah, I don't know. Like people get
because you see
invested.
that with stocks, you see short theses and short reports and those sort of things, but you don't really see that with a lot of commodities. Now,
Yeah, it's
even with
weird.
commodity stocks, you don't see it as much. Maybe just because they should be covered plenty too. But yeah, I don't know how to explain that. But maybe we're wrong and it's just a feeling. But yeah, at least from my experience, yeah, I'm totally with you there. I haven't seen really much on the bear side.
Oil's
Mixable
maybe a bit
opinions.
different. There are some oil bears, but if you go to like if you go into the copper arena,
Yeah,
it's
metals.
all just like electrification, this and everything's going through the roof, and then the copper price doubles, and people go, "Copper still see
It's
it's
just
true.
starting. It's just starting.
It's just starting." We're like, "No, this is the end." Get out.
Yeah. Oh man, yeah, that's totally right. Um, what about maybe we kind of wrap up our discussion on the whole patience idea with contrarian investing? Is because it's contrarian, you don't have a lot of people on your side, so you have to be patient, or maybe stubborn, if that's the right
Yeah,
word.
maybe.
So maybe just arrogant. You have to be on the other side that people are taking, and you're probably going to get flack. You might get flack for it, or at least you'll see a lot of things that are going to be questioning what you're saying, and that's going to be exhausting for just about anyone who's analytical, I would think. What do you think?
Oh, sorry, I didn't quite get it.
Well, yeah. Just what do you think about the patience required? Is that the number one thing here? Is that the biggest limitation, I guess, or the biggest thing you need to do contrarian investing? Just patience.
It's a little bit, but I think if you have a catalyst and a date, like sort of a range of time frame you're looking for it,
Mm-hmm.
you just need the patience to get to that point to see if you're right. But if it's a buy and hold forever and just waiting, like that's I don't know if there's any more patience that you need, because like if you're buying Google for the long term, you still have to wait 10 years to get all your money out of it, right?
Right.
So I don't know if there's any more, like investing is a patience game, right?
Yeah.
So
Yeah. I was thinking the same. Just like you need to need to be patient in any form of investing. And I'm not going to count like day trading as investing, because that's its own thing. But for proper long-term investing, you have to be patient, and that's in any asset class.
Jack, do you have any Chinese stocks?
No, not anymore. I had some Alibaba, but that was it. And even then, I was kind of hesitant on it. It was really more of a clone of, definitely not contrarian in that sense. It was a clone of a lot of others that were in it, and Charlie Munger being the big one that kind of set it off. But yeah, I never felt really good about that one. But yeah, why do you ask?
Well, I mean, that would be an example of a contrarian play that requires patience, right? It's just like been beaten down forever.
But what's kind of weird actually is just within this value space, because we're on things like this with the punch card community and kind of the similar overlapping communities in the value space. It's a pretty small world, at least in this kind of corner of the value world, this sort of long-term Buffett school, I'll call it. Like, it's not tiny, but it's definitely pretty small. And I feel like even within the smaller community, you almost get like a sort of echo chamber going. Maybe it's similar to kind of the gold bug thing, where it's a relatively small space, but everyone seems to be saying the same thing. And I feel like we've gotten that with Alibaba at some point. Maybe just the way algorithms work, you start seeing a lot of similar stuff. But that feels like a problem. I don't know if it is or not. I don't know if you feel the same way about that.
Oh no, I didn't really know how to put it to words, but I think you've just done it. I think that's totally true. Like, and you must notice, like, since you do videos now on stocks, like my following is not very big, but like I get people telling me back my own thesis, right? And I'm like, I don't want to hear that. I know that. Tell me something. Argue with me. You know what I mean? Like, I don't need to know.
Right. It's just, I think it's just the nature of social media and the internet in general. It's very good at putting similar groups of people together. That was one thing I was actually kind of worried about with the Berkshire Hathaway annual meeting. Was just, you're going to meet a bunch of people who all think the same thing. And yes, there was a lot of common values, we'll say, a lot of long-term investors, patience and trying to get educated, which that was a good common denominator to have. But I was pleased to see that there was a lot of diversity in philosophies and positions on things. So that was actually pretty good. I was a little worried for a second, but it's such a big event that you get a good mix of people.
Is that the first one you've gone to?
Yeah, it was the first one I went to this year.
Congratulations! So, that's awesome.
Yeah, have you been to it?
I haven't been to one. It's still on the list, and I don't know if I'm going to get there.
It's worth a trip. It was very good. It's a very good group of people. We had our punch card event, and that went really well. And it was good to actually meet people who've been participating on our live streams for quite some time, and others who just had a friend who knew about us and came in. It was really cool. So I definitely want to do that again next year. But yeah, back to kind of the original point, just like, especially on the internet, it's very easy to get into your niche echo chamber, even if it might be an echo chamber of 100 people. That's enough to create some serious confirmation bias. And that's a problem when you're trying to be contrarian, right? Or maybe it's not a problem. It just depends on how stoic you are, I guess.
I'm looking at the comments here. So Eunice has said that, Turkey, nobody's covering Turkey, right? And I think that, like, now that we have Pabrai who's in Turkey, right? So all of us are looking at Turkey, right? Maybe the later investing community isn't, but like, as a contrarian play might be something more like Russia, right? That would be super contrarian, right?
Sure.
I mean, even China's in that basket now too, right? So I think that, but I do think, these countries, like if we look at countries, Argentina was a big one. Like, I was actually looking at Argentina when they were in the middle of their total meltdown, maybe 3 years ago, and I bought one stock. I wish I had bought more, but like, just looking at specific countries that are having problems, because, like, I don't know. Have you read Dalio's debt book?
I had the more recent one, the Changing World Order one, or Yeah,
it's the one before that about debt.
I've only read Principles from him, so I've read the debt one.
Okay. Because he basically says, like, he talks about how countries go through these debt defaults and everything collapses, but then there's natural adjusting mechanisms, right? When the currency gets killed enough, then the exports become really valuable in the country. Right. You get the foreign currency, and it naturally reverses, right? So if you get a situation like Turkey or
reversion to the mean, if you will, right?
Yeah.
Yeah.
Yeah, exactly. Right. They don't just go to zero. Countries don't go to zero.
Well,
sometimes they
usually, even in bad situations, they usually don't go to zero, but sometimes they definitely do.
I guess Zimbabwe, right?
Yeah, a number of examples in history, but they're pretty rare. That's why they're notable. At least rare within a lifetime. It's pretty rare. If you stretch it out over enough the time horizon, then it's common, but right. If it's just in every 100 years, it's pretty rare. Okay, well, I guess any final thoughts there? Definitely, I think we kind of covered a lot of interesting philosophies there, if I do say so myself, Mike. Anything else you want to talk about?
No, you asked great questions, Jack, that we just led the conversation right down a great path. So
we were just going wherever the conversation went. I don't know. and shout out to our man Eunice, who was very active in the chat. I guess with that said, everyone stay tuned for next week. We'll be having Mike's first episode of his show here on the Punch Card Investing channel. So definitely stay tuned for that. Definitely be in the more contrarian side of things. So if you liked this, then you definitely will enjoy Mike's show. So with that said, like, comment, subscribe, all that great stuff. And until next time, everyone.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.